Hey guys, Adam here from DirectionTrader.com. Let's do an education video on the stochastics. Today we're going to talk about the slow stochastics, but a lot of you may use something called the fast stochastics. There's a slow stochastics, which we're going to use today because it's probably the most commonly used. There's a full stochastics, and then there's a stochastic momentum index. All of them pretty much do the same thing for you. It's an oscillator that we use. I also recommend using it in conjunction with another indicator, such as a MACD or anything along them lines. But today we're going to go over the stochastics and we're going to talk about what it is and how maybe to use it. Alright, in this situation we're going to go over the slow stochastics. As you see here, we have two separate lines, and what them are what we call %K and %D. I'm not going to go over the formula that creates them, but basically %K is a momentum of the current market, and the %D is a 5-period, I believe it's a simple moving average of the K line. So pretty simple, right? Not too tough, but yeah, all you need to know is that they're basically an oscillator that is a banded oscillator, meaning we have a banded, we're in a sideways range here ranging from 0 to 100. In this situation, you see 30 and 70, 30 being overbought or oversold, and 70 being overbought. Sometimes you will see them numbers as 80-20, meaning that the 20 would be the oversold line and the 80 would be the overbought line. But in this situation, we're going to use the 70-30. And you will see it will oscillate as the market and the price fluctuates. So, how to use this thing? In this situation here, we're going to go over it in a downtrend. The same thing would be applied in the uptrend. In fact, you were in a sideways ranging market. It's a great way to use this tool as well. Now, I'm going to steal from some other people who went ahead and covered this in the years past. A lot of them talk about waiting for it to go ahead and roll below or above the overbought and oversold area. That's one way I recommend entering this position. The one time I do not recommend using this oscillator would be if you're in a downtrend looking for a buy opportunity. That is a no-go because the markets can trend. That's what a trend is. It's a continuation of a direction of the market. So, as you see, this oscillator can stay overbought or oversold for an extended period of time. So I'm going to throw the moving averages on here, make sure we understand which direction we have them pushing down originally and then in an uptrend later. So as you see here, in an uptrend we can stay overbought for an extended period of time, or in a downtrend we can stay oversold for an extended period of time. So we never want to use this to sell in an uptrend, and we never want to use it to buy in a downtrend. Just my opinion. So how to use this? There are 3 ways I'm going to recommend getting into it. Number 1 would be as the market is in a downtrend and it pulls back. We have this downtrend and we get a pullback, right? Whenever the market goes from overbought or oversold to overbought, you can look for the %K to cross below your overbought line. So a cross below overbought line. So that's one situation to enter in a downtrend. Cross below your overbought line, such as downtrend, cross below, entry, cross below, entry, cross below, entry. Okay? Second would be a, let's see here, your %K cross below %D. So I know this is a little bit sloppy, guys, but I'm going to explain it. So to get into it a little earlier, so let's go back. We've already used up these examples. Let's go back over here and say we got a pullback here, and we got the %K when the momentum is to the upside. We got the %K above the %D. So when it crosses below the %D, in this situation here, that is when you enter short with the direction of the trend, always. Does that make sense, guys? So you got %K above. Whenever %K crosses below %D, selling opportunity. So there's your second choice. And then your third, and you don't hear this a lot, but when you go from oversold to overbought, use them candles to your advantage. So we're going to take this and we're going to go up here and we're going to draw it. So we basically have candles that are forming to the upside. So as we're pushing to the upside and we become from oversold, as we become overbought, we're going to start to put sell orders a tick below these candles. And as we form a new candle, we got to move it up. We pushed up higher, we pushed our sell order up a little bit higher. So now that our sell order is now a tick below the high candle. So we're basically going to get taken into this market. So now we're going to be short as we get taken into this market back in the direction of the overall trend with a stop above the high. So in this situation, you would have an entry a tick below this high candle with a stop above the high here in the direction of the overall trend. So one tick below high candle. Okay? Alright, so those are three pretty good examples on how to enter a trade when using the Stochastics Momentum Index. Hope you guys enjoyed this video. If you have any questions about it at all, you can go ahead and email me. It's adam@directiontrader.com. If not, thanks for watching, and I hope you enjoy these videos and look forward to the next one that we make. Have a good day.